Hi, everyone. It is Friday. And as you know, on Fridays here on Recharging with Champions, for your daily jumpstart, we like to give our realtor partners and other people that are in the real estate industry just kind of an update on what is going on in the mortgage market when it comes to interest rates. Very much a hot topic. So today we are going to jump in, take a look at what the mortgage backed security market has been doing this week, what it looks like over the last 6 months, and just kind of dive into what is causing these changes and what that means for your borrowers. So let's jump right in. And if you will look right here at my mortgage backed securities, now I know that's a little bit small, but this is a graph and every day is represented by a bar. So we are looking at the last 6 months here. And I just want to show you, let me zoom in here a little bit so you can see a little bit better. Here we are. This is when the rates last week just started to deteriorate. So this means the rates got a little bit worse. Remember, if you haven't watched this before, when the market does poorly, interest rates go up. When the market does well, your interest rates go down. So you can see all of last month, even the month before, we were in a really nice positive market change. So we were seeing those interest rates drop. Last week, we did have some reports that came in. We had a job report that was much hotter than we expected, which just caused this market to then deteriorate again, causing those interest rates to go up. And this week, we have seen, again, pretty steady. So you see these last little bars are staying in the same realm. No big drops like we saw last week, but they are going still in the negative direction, which means rates are going up just a hair. So on the 30-year fixed, what does that mean for your borrowers? A 30-year fixed interest rate, if you look up what the national average is, and remember, interest rates really, really depend on your credit score, your loan type, down payment amount, loan size, where your loan is, the house type that you're doing. There's so many different factors that go into someone's interest rate, but the national average right now has peaked over the 6%. So we're looking in the low sevens right now for the national average on a 30-year conventional. On your government loans, your FHA, your VA, your USDA, loans like that, those interest rates are still in the mid to high sixes for the national average. Again, this can change based on your perfect situation. Call your mortgage banker, ask them what your interest rates are if you would like to know what your specific rate is. But if you've got clients out there searching and they're asking what the interest rates are, the national average is a good place to start, and then they can go get a honed in rate from their lender. So, what does that mean for somebody that started shopping 30 days ago? It means that they need to go back in and readjust their max purchase price. They need to readjust what they're looking for to make sure it is in their budget, because that difference, we were in the low sixes and now we're in the low sevens. That difference does make quite a huge impact on that monthly payment. So let's make sure we're not showing properties that they can't afford. Secondly, what that means is it's kind of stable. So I would expect, based on what we're seeing right now, based on the reports that we've had this week, it's probably going to stay pretty steady over the next couple of days. So if I was telling somebody, if I was showing property, I would feel pretty comfortable looking at a 7% interest rate to run numbers on. With that being said, this week, the big news that we had was where there's two big things. One was the jobless claims came out, and it actually was much higher. We had more jobless claims than what we were expecting. So that does show a little bit of softening in that job market, which oftentimes will help inflation and oftentimes help your interest rates. Also, the feds did release their notes. And even though those notes were from before the job claim came out that caused this major change in our market that you're seeing here, it did really speak to the fact that they expect that the housing market, things like that, are really probably stagnating, and there is going to be a curb on inflation and the actual economy is slowing down slightly. With that being said, we still are hoping for some rate improvements in the future. So that is basically your interest rate nugget in a nutshell. Remember, if you would like to create a video that is all about rates, or maybe just show this little graphic here, remember that I do have that in our toolkit. So if you just want to jump in the description of this video when I'm done, you're going to see the toolkit. Any of our podcast videos that you've seen in the past have that toolkit. So you can go grab the graphic if you'd like to grab the graphic and use it for your social media. Also, as soon as I'm done here, I'm going to jump off and make my own social media post about the interest rates for my clients. You are more than welcome to take that post, share it, do edit, do what you will with it if you just want a basic overview of what the market is doing. Happy house hunting this weekend. I wish you all and all of your clients to find the most amazing house and the most amazing deal. Remember, if you watched earlier this week, October is a great time to go into contract and find a good deal on a house. Make sure your buyers know that. We'll see you on Monday.